afternoon, everyone. I think we'll get started. I'm Rob Atkinson, I'm president of ITIF. I want to welcome you to an event on ExIm Bank reauthorization and financing. And we have a great panel today to talk about this issue. I'm going to introduce people in just a minute. We will hear first from Congressman Robert Gold, who is a new member of Congress. It's his first term. He's from the North Shore of Chicago. In fact, we have the distinction of going to the same high school, along with Anne Margaret and Stephen Queen, and a few others. A few other famous people went to New Jersey. So, Rock Hudson, Charlton Heston. No, I don't think I'm as famous or as good looking, but maybe you are one of them. But no, we're really pleased to have Congressman Dole here. He is the vice chair of the International Monetary Policy and Trade Subcommittee of the House Financial Services Committee, and in that role, he's playing a key role in the reauthorization of ExIm. And today, in fact, there's markup happening right now, so really appreciate you taking the time to join us. Joined by Fred Hochberg. Fred is the chairman and president of ExIm. He has been in that role since the beginning of the Obama administration. Prior to that, he was the dean of Milano, the New School for Management of Urban Policy in New York. And prior to that, from 1998 to 2001, he served as deputy and then acting administrator of the Small Business Administration. And prior to that was president and chief operating officer of Lilly and Vernon Corporation. To Fred's left is Gary Huffbauer. Gary probably needs no introduction. If you're involved in tax policy in Washington, you should know Fred. He's the Reginald Jones Senior Fellow at the Peterson Institute for International Economics, and has been in that role since 1992. And prior to that, he was at the Council of Foreign Relations, and he's had posts at Georgetown, and he was also Deputy Assistant Secretary for International Trade and Investment Policy at Treasury back in the 70s. I'll introduce Congresswoman McCarthy when she joins us. She'll be joining us as well. So let me just start, and then Stephen Ezell, a senior analyst at ITIF, will make some comments on a report we're issuing today on ExIm. Let me just make a couple of quick framing remarks to turn over to Representative Dole. When you think about ExIm, there's really sort of two sets of issues. There's the micro sets of issues, what should be the various rates of domestic content, what sectors, and all of these issues, which are certainly important. But at the broader level, there are really two big issues that get debated about ExIm. One is this claim that ExIm picks winners. So there's a recent study by the Pew Charitable Trust, a project called Subsidy Scope, and they said ExIm financing potentially helps decide which companies survive in a tough economy. To which I would say, thank God it does, because the companies that help survive in a tough economy are U.S. companies. The tough economy is an intensely global and competitive economy. So yes, it does pick winners. The winners are U.S. companies. And if we don't pick those winners, if we don't help U.S. companies export into global markets, they are going to lose. And other countries and their companies are going to win, and the end result is going to be the significant loss of U.S. jobs. Partly because we know from very good academic research that exports lead to twice as many jobs per dollar of production as does domestic production. So exporting plays a key role in the economy. The second argument, and you'll hear this from groups like the Cato Institute and others, is, look, what ExIm is really all about is trying to make sure that we're competitive and have a good balance of trade. And what they will argue is the trade deficit simply doesn't matter. There's nothing we can do about it. It's all just simply an accounting function of, we don't save enough. The fact is that that's simply wrong. One of the reasons why we don't save enough is because we're not creating the jobs we need in the high-wage jobs to be able to have full employment in the U.S. economy around them. So clearly, if we had more exports, if we had better balance of payments, we would boost savings and we would boost jobs. And the last point I'll make is there's a very nice study, an NBER article, National Bureau of Economic Research article, by three economists. One of them mispronounced, Jagannathan, Kapoor, and Schomburg being an economist at the New York Fed. And they analyzed, they had a sort of contrarian view of why the financial crisis emerged, which is certainly our view as well. And they argued that the reason the financial crisis occurred was the significant deterioration of U.S. competitiveness in this decade. In the last decade. And what they said was, we argue, quote, we argue that this pattern, that is the big increase in the current account deficit in the U.S., matched by big increases in the current account surpluses in countries like China, quote, precipitated the housing bubble in the United States. So clearly there's a very clear causal link between the health of our exports and what happened in the financial crisis and the near meltdown of the U.S. economy. And I would argue we see the same connection now with the anemic job growth. If we had strong exports, if we had stronger competitiveness, we would be creating more jobs and having robust recovery. And ExIm Bank, because of the role it plays in a very important role in making sure that we can continue to drive U.S. exports and competitiveness. So that's really the context of why we're here today and why this is such an important issue. And so with that, I'll turn it over to Joel.
I certainly want to thank you all for coming in. Rob, thank you so much for inviting me. I want to certainly thank the Information Technology and Innovation Foundation for inviting me just to come and talk to you. We are actually in the midst of the markup of reauthorizing ExIm Bank right now, which is why the ranking member of the subcommittee is a little bit delayed. She was actually in the midst of going over the amendment. Okay, it just got passed out of committee, so that's a good thing.
I think we can go home. Yeah.
That's it? Okay, everybody wrap it up. Sandwiches are at the back. Yeah. Actually, and when we look at this is, when we look at coming out of the subcommittee, it was the way markups, I think, probably should be. I think the markup out of subcommittee took about 9 minutes. And so, certainly I'm delighted to be up here talking to you about ExIm Bank. I want to thank certainly Chairman Hochberg and for your leadership, obviously in keeping Export-Import Bank operational and successful. As a small business owner myself, I can tell you that I certainly appreciate the importance of ensuring that responsible credit is available for businesses, especially small business and exporting businesses. In the 10th District of Illinois, we've got 650 manufacturers representing 80,000 jobs, 43,000 of those jobs represent exports. Those jobs, so, and we know that increasing exports by $1 billion translates into roughly about 6,200 jobs. It's about jobs in the economy, and that's certainly been one of the things that I've been focused on here. It still remains my #1 focus is to try to jumpstart the economy and create jobs. And one of the most important and effective actions we can take in supporting job creation in the economy without increasing our paralyzing national debt is to reauthorize the Export-Import Bank. And so out of committee and going on to the floor, that's going to be very important. The ExIm Bank serves a critical function in providing credit to directly and indirectly support exports by small, medium-sized, and large exporting businesses. These activities directly facilitate job creation right here in the United States. In fiscal year 2010 alone, the bank's export financing activities supported approximately 227,000 American jobs in over 33 different companies. Historically, the bank has helped finance American exports to over 175 different countries. This is obviously critical today. We're looking at a world that is flatter than it's ever been before. We're competing in a global marketplace, and we have to do so against foreign companies, and Export-Import Bank is critical in that role. It supports both large businesses and small businesses. In the 10th District of Illinois, and Chairman Hochberg, correct me if I'm wrong, we normally think of the Export-Import Bank helping the large businesses. And there's a big initiative to try to help smaller businesses. Well, in the 10th District, there's an enormously large percentage. I think it's over 75%, actually 84% last year were small businesses. And that to me is fantastic. And that's something obviously that we want to continue. And so it really helps jobs, I think, when we're talking about supporting big businesses in two different fashions. Not only does it directly impact small business, but when a large American exporter exports a commercial jetliner, a locomotive, a wind turbine, they're effectively exporting millions of assembled individual parts, many of which come from thousands of small and medium-sized businesses throughout the United States. So each and every one of these businesses are going to be impacted in a positive way when larger corporations are helped by Export-Import Bank. So not only is it done directly, but it's also done indirectly in terms of helping out small businesses. And when we look at how do we get out of the mess that we're in right now, I've argued that we need to be focusing on small business. 2/3 of all net new jobs are created by small business. There are 29 million small businesses in our nation. If we can create an environment where half of those businesses can create a single job, just think about the job growth we're going to have there. And Export-Import Bank certainly, I believe, will play a very critical role in that. One of the most important reasons for reauthorizing the Export-Import Bank is that every major foreign exporting company receives very generous government-supported export credit facilities, most of which are on far more favorable terms than those to those foreign companies than those that the Export-Import Bank can provide to American companies. And without the Export-Import Bank, global competitive playing field is going to be uneven. And we want to level that playing field as best we can to enable United States companies to compete more effectively. The bank does not displace private sector capital. Instead, the bank finances American imports in markets where private capital is limited or unavailable. This was most clearly illustrated during the recent global economic downturn. Private credit markets were frozen, and the private sector credit was unavailable to American exporters and to their foreign customers. In response, the bank filled the gap to finance our American exporters, and by extension, to support American jobs. For all of us who are concerned about exposing the taxpayers to undue risk, and I know that I'm certainly not alone in that, we can look back to the bank's track record. Since 1934, the bank's default record has been about 1.5%. And that's, just to put that in perspective, a much lower default rate than you could reasonably expect in private commercial lending transactions during that same historical period. Additionally, the bank's history shows positive surpluses, all of which are returned to the United States Treasury. Since 2008, the bank has returned over $550 million in surplus to the United States Treasury, and over the past 5 years, it will certainly be in the billions. Finally, I'd like to just thank all those that are involved in terms of the work that they put into reauthorizing it, getting it through committee. Certainly, Chairman Miller was concerned about, again, looking at default rates, and we've got a clause in the bill that will allow Congress to review if indeed default rates of the ExIm Bank exceed 2%. The bank is a self-sustaining agency that provides the needed export financing where private sector capital is unavailable, and in situations where American exporters are competing with foreign exporters who are generously supported by very aggressive foreign governments and export agencies. The bank directly supports American jobs without increasing that debt. I want to make sure that we highlight that yet again. And it's just crucial for American jobs. This is, I think, a win-win situation. It's what we should be focusing on. I think it's got, obviously, tremendous bipartisan support. And when we're looking at what can we be doing in order to level the playing field. So I've been very happy to be a co-sponsor of the reauthorization legislation, to work with the chairman and the ranking member, and both my Republican and Democratic colleagues, to reauthorize the bank's charter on a long-term basis. It's essential for American exports and for American jobs. And again, I just want to thank the foundation. Rob, thank you for your help and your effort. And certainly want to thank the chairman for all of your work. And with that, I'll return it back over to you.
Do you have a couple of minutes for questions?
I'm happy to take any questions. We got
Just if there are just a couple of questions for the current one before you jump in. There you go.
This is my kind of crowd. Okay, perfect.
Thank you.
Thanks so much.
So there are lots of chairs around, folks in the back, if you want to come up. So I introduced Chairman Hochberg. If you want to share your thoughts with us, we appreciate it.
For brave souls, there's a chair right here. Congressman, I just want to thank you for your work on this, work on the reauthorization, and importantly, as I listen to your comments, having someone who understands what we do and as such a strong advocate is really appreciated. So thank you very, very much.
Thank you, sir.
Well, thank you for having me today. Thank you for inviting me. And I actually see Greg Dole from Boeing in the back corner. I just returned from the Paris Air Show. I was there for the last 2 days, where Boeing faces off with Airbus and Bombardier and to some extent Mitsubishi Regional Jet. You know, there was a time, we talk about competitive, there was a time in the late 90s when essentially American aircraft manufacturers controlled 90% of the market. It then became, I never heard this term before, it became a duopoly instead of a monopoly. We had Airbus and Boeing sharing about half the market, and that's also now changed. We've got Embraer from Brazil, Bombardier in Canada. The Chinese are coming out with a plane called the Comac 919. It looks remarkably like a 737. It's just funny. It's remarkable, the similarities, including the little flat part of the engine on the bottom, which it has a remarkable similarity. And the Russians are coming out with a plane. I mentioned the Japanese. So what that's just one example in one industry of how the competitive landscape is changing. I'm very happy that our bill was passed out of full committee just minutes ago, and I've got Scott Schlegel and Bill Hellert and our Ledge Affairs team who thank you for your work on that, Al. I think that in inviting me here and Robert, you know, what ExIm Bank is about, it is about competitiveness. It is about finding ways and ensuring that American companies can maintain their competitiveness on a global marketplace. And when I meet with small businesses and large, but particularly small businesses that are doing, and I ask them, how's business? They're having a really good year, and they're looking forward to a really good 2012. Now that's a very different picture than when we talk to business owners or people who are now working or looking for jobs, because what is growing is the export sector. And partly our role is to make sure that American companies are competitive as they're dealing with global marketplaces. And I'm going to talk about in a moment. And just to pick up on the comment that Rob made about trade deficits don't matter, let me just actually make a comment. The best thing we can do about a trade deficit is export more. It's unlikely we're going to import less. We may import a little less foreign oil, we get more energy efficient, but you know, we're not going to go back to making consumer electronics, we're not going to go back to making clothes, t-shirts, sneakers, and so forth. What we can do, and what we do, is to be exporting more goods and services so we get the balance right. It's a little bit like diet and exercise. You know, you have to get both of them in line, and if you can't control your diet, you better exercise a hell of a lot more. So what we need to do is we need to exercise our exporting ability and our export competitiveness. Just for a quick history, the bank was started in 1934 by FDR. For those who care about the deficit, in addition to what the congressman said about we've actually generated $3.4 billion back to the Treasury in the last 5 years. The desk I sit at was the desk of the first chairman of ExIm Bank. Anyone here from Houston? All right, it's the same desk that Jesse Jones from Houston had, so it's your taxpayer dollars at work. That desk is 76 years old. So what we do is we are really financing or helping or providing guarantees for American companies that are selling overseas. And we frequently focus on market gaps. When we initially started and to this day, we're helping companies export largely to places like Russia, Latin America, Africa, Asia, places that are a little less accustomed for American banks and American companies to do business, where they need the assistance of the U.S. government to provide some guarantees and some support for those sales. And what we work on, and the Congress made a good point, what we're really trying to do is to make sure there's a level playing field. There's an organization in Paris called the Organization for Economic Cooperation and Development, OECD. People familiar with the OECD? When I was at the university, they used to refer to it as the Organization for Endless Conversational Dialogue, which perhaps on some days is also accurate. But, and I know I'm on the record, so I'll be careful with those comments. I love the OECD, I just want to make that. What our goal and what our work there is, it's about leveling the playing field. We believe, and we believe rightly in a market economy in the United States, we believe that we ought to let American companies compete on the attributes of their products, services, and price, and take out distortions of government subsidized or government supported financing. So that's what the OECD does. That's what we're continually working towards, to have a level playing field so companies can compete. However, it's frequently uneven. Sometimes other governments are putting a lot more money behind their companies and helping them compete. Largely, those are countries outside of the OECD, and particularly of late, countries like Brazil, India, and China, which are rapidly growing but are not members of the OECD. So that's something we're continually trying to keep that level playing field and to keep a level of transparency. So that's what we're working towards, and what this reauthorization helps us do is do a better job of making sure that playing field is level. So I only point to Greg here, so when Boeing is selling, that they are able to sell on the same terms and conditions the Airbus is selling for, or Bombardier, so that the customer can choose the right equipment or the right product and not be influenced because someone is giving them a special deal. I mean, think about it. If you go buy a car and one dealer is saying, well, it's 0% financing for 4 years. That's not, you're no longer looking at the attributes of the car, you begin to look at the financing. We're trying to take that out of the equation as best we can, so that that's not a factor in a customer's decision. One of the things I often think of my role is, and a lot of the reasons American companies don't export is the concern about risk. Risk in markets like I mentioned, in Russia, Latin America, Africa, Asia, risk in how do I collect on a credit that's overseas? What do I do if I sell to New York, New Jersey, New Mexico, I know what to do if they don't pay. If I sell to New Zealand or New Delhi, what do I do? So we provide an insurance on receivables. So if you're particularly, this is mostly for small businesses, large, but not entirely. If you're selling to a company in a foreign country, what we will do is we will guarantee the receivable. We will actually do a credit review. We will guarantee the receivable. So if you're not paid, we will make sure that you get paid for that, then we can go collect. That's one of the portions of business we're in, and I refer to that business, I feel like I'm in the sleep business. What I do is I cure insomnia. If you're a small business owner and you're selling, I have a company that's selling to Egypt. It's a company in Florida, from Miami. Anyone here from Miami? A company called Dematec. They sell medical sutures. So where are his customers? Of late, Egypt, Iraq, Saudi Arabia, Libya, Sri Lanka. These are not easy places to do business. So what we do, he sells them. We guarantee the receivable. So on that receivable, Luis does not lose a wink of sleep because he knows that if they have trouble paying, we will pay. He doesn't put his business at risk, and at the same time, make sure that he can make the sale. That's one key area. Another company we work with, actually it's a great company called Zero Motorcycles. They make a fully electric motorcycle out of Silicon Valley, and they're now selling to places like Singapore, Mexico, and other places in Asia. In the same case, they are selling overseas, we guarantee their receivables, so that when they ship these motorcycles over to Singapore, they know they're going to get paid back. This is a company that started with 8 employees. Last year they had 30, this year they have 62 employees. And about 70% of their sales are export sales. And the last company, which is actually in the information technology area I'll talk about, is a company called Patent. Patent is a company that makes telecommunications routers. They compete with Cisco, they compete with Huawei in China. We provide them with working capital loans. They have a $4 million line of credit that we guarantee to their bank. As a result, with that $4 million, they can provide credit to their customers and buy the inventory and finance their receivables and finance their work in process until they get paid. Those are the main ways we work. We work on insuring your receivables, we work on working capital loans, and the last piece, which deals with larger pieces of equipment, be it a Boeing aircraft or could be a large IT system, we will help the buyer in a foreign country obtain financing. So that if we just did a transaction, to give an example, it's out of the IT area, but it's a recent transaction. We helped sell locomotives to South Africa. Now, frankly, there was one bank that was willing to finance that deal, and they only would do it because we would guarantee that transaction. So This was a case, it's General Electric locomotives being sold to South Africa. We guaranteed the loan, Barclays therefore made the loan. Now, they may say, well, what does Barclays need ExIm Bank? Why does GE need us in the deal? Well, GE is competing against the Chinese, they're competing against the Germans, they're competing against the Japanese, the Spanish, all making locomotives, and the financing package is critical to making that deal. If Transnet, the rail company in South Africa, is buying their locomotives, well, doesn't want to just get the locomotives, they need to understand what the financing package is. So we made sure they had a competitive financing package so that they could choose the GE locomotives based on the product attributes and not be impacted by financing as being a factor in making that decision. So that's the basic ways to work. Insurance, working capital loans, and assisting through guarantees for buyer financing. This is all part of the National Export Initiative President Obama announced in his first State of the Union. In our first year, we're up 17%, which puts us on track to double exports in 5 years. If you think about our economy, there are a couple of, what drives our economy? It's going to be driven by four elements, essentially. Consumer spending. It's unlikely we're going to see an increase in consumer spending, and that's 70% of our economy. It's government spending at the state, local, and federal level. That is not growing. In fact, you all know this, at the local level in particular, and even at the federal level, expenditures are going to be decreasing. It's business investment in new plants and equipment. That's growing slowly, frankly, because with a slow growth economy, there's not a great need for investment. And the fourth key element is exports. If we don't grow and build exports, we are not going to reboot this economy. So that's why this National Export Initiative is so important from a broad policy point of view. As I mentioned, we're up 17%. One thing we've done at the bank in the last 2 years, we have focused on a handful of countries. We operate in 180 countries. We focused on 9 in particular that have really large growth and largely, particularly in the infrastructure area. And I'll just quickly give you those 9 countries to give you a perspective. Starting in this hemisphere, it's Mexico, Colombia, and Brazil. Moving around the globe in Africa, it's South Africa and Nigeria. Those 2 countries alone account for half the GDP in the entire subcontinent, in sub-Saharan Africa. Turkey, an economy that's growing in the 10-11% range. And then continuing on the globe, India, Indonesia, and Vietnam. We see these 9 markets as being critical growth areas, so we're putting more emphasis and more attention on those areas so that's where we're going to see the greatest boost in exports and, most importantly, jobs. As the Congressman mentioned, last year, based on the transactions we did, we supported or created 227,000 jobs, just under 250,000 jobs, and frankly this year we are 7 months into the year, we're on track to, I believe, we're going to do better than that even this year. So let me close by saying I'm particularly happy that our reauthorization passed the committee this morning. The other thing I would, and the best thing that we can do is to help get more American companies to be selling overseas, more companies to be leveraging. One of our greatest assets is frankly the Made in America brand. People want to buy American goods. People rely on American quality, American innovation, American service, and frankly a hallmark of doing business with America is a straightforwardness. When American companies sign a contract and say we're going to deliver on July 15th, they deliver on July 15th. It's a very transparent process. And that's really valued. And what we're here to do is to make sure we can support those companies and support those jobs so that we can reboot our economy and put more people back to work. So with that, I'll turn it back to you. Yep, I have time for some questions if you want.
You want to do questions?
I have, that's got to be someplace to go. So
Let's do this. Why don't we do that? If there are questions for the chairman, we can take a few now. And
yes, just say your name.
My name is Rebecca Taylor. I serve in the SAP Advisor's Office. I'm really curious about 1 or 2 examples of maybe situations where our companies are still getting beat and whether they tend to be non-tariff procedural type barriers or whether there are things that you believe are maybe on your list for future activities for ExIm to take on.
I think in terms of other barriers, I would say one of the biggest barriers we face is I'll divide it into two areas. One, there are a large number of non-tariff barriers where countries, Brazil in particular, has put in high local content requirements so that it's very hard for American companies that are trying to export into Brazil because of their high content rules. So that's something we are continually working on. Work closely with Ambassador Kirk at the U.S. Trade Representative's Office to really not just deal with tariff barriers, but those non-tariff barriers. And I would say the other thing that impacts our competitiveness is, frankly, the OECD, which has served very well for over 35 years in leveling the playing field. The difficulty is those are the approximately 30 countries that are sort of the industrial countries that have agreed to how we have a level playing field. The difficulty is we have countries like China, countries like India, countries like Brazil that are not members of the OECD, that are not transparent, and that makes it much more difficult for American companies to compete with them because we often don't know what those financing terms are. So those are two things we're working hard on. Yes?
I'm from Manchester Trade. My firm works a lot in helping US companies to export in African countries. And we always have the same question from those clients. They always want to know how we can compete in Africa against, regarding the fact that the Chinese companies have access to Chinese free-flowing credits. And it's a little bit like we were saying about OECD, so.
Well, what we can do, I'll give you an example. We have an example in Pakistan where two U.S. locomotive companies were competing for a rail order in Pakistan, and we got reliable information of what the Chinese were offering as competitive, or I could call it non-competitive financing. In that case, we worked with the administration and the Treasury Department, and we ultimately informed the OECD. These are the terms the OECD said. China is offering lower fees and a longer term, and we are matching them. And as a result, we gave our U.S. manufacturers the exact same terms that China did. So I would say to your clients in Sub-Saharan Africa, if you can bring us reliable evidence of what the alternative offer is, we will make an attempt to offset it or match it in some way so we can take financing off the table for countries that are not part of the OECD at this time. Yes?
Sorry, I just came in, so it might...
You missed a brilliant talk.
Sorry.
I'll start over. I can start over.
No. I don't want to back again. I'm Tzvi, I'm from the Israeli embassy. And so we're talking about credit and export and all that. To what extent these lines are encouraging or making possible cooperation, partnership with other countries, with the US, of course, to do anything in those 9 countries that you mentioned?
Well, I actually just met with ASHRA, am I pronouncing it right?
Yes,
the Export Credit Agency of Israel just last week, and we talked about exactly that, working together. We're looking at a project in China that's involving Case New Holland in America, an Israeli company, to do some agricultural products in China. So we do a lot of what's referred to as co-financing. We do that with the Export Development Bank of Canada as a particularly strong partner. We do that with the French, the Danes, Germans, with probably well over a dozen countries. We actually do a lot of joint financing on those projects. So that is something to do.
It's possible.
It's possible, and we just met a week ago.
Okay, I know that.
Uh-oh.
Sam Gilson with Washington Tariff and Trade Lab. You mentioned China, Brazil, and India, and in your competitiveness report this year, it showed that those 3 countries actually exceed OECD financing for long-term, medium-term financing. Beyond just reacting to cases where somebody comes to you where they're being outbid on financing, what are you doing affirmatively to sort of go after those 3 countries and their practices?
I think there's 2 prongs. The question is, I gave a talk just last week. If you look at the export financing provided by Brazil, India, and China, last year, those 3 countries, and China was the large part, but those 3 countries provided more support to their exporters than the entire G7 together. And just to remind you, the G7 is the United States and Canada, the UK, France, Germany, Italy, and Japan. So those 3 developing countries, those 3 emerging countries, provided actually more support than the entire G7. what we're doing is twofold. One, obviously, we can respond when we've got an unfair level of support. More importantly, we're trying to advocate to find ways to bring those, to find ways that we can bridge and bring them into the OECD. And there are really two aspects there. One is getting transparency, which would go a long way, even if they're not going to be a part of it, just be transparent as the others are. And then secondly, finding ways that we can make them, incorporate them into the OECD or into some international framework. I'll leave it be a little more vague. We need to find international frameworks that we can competitively do business, allow companies to compete and not to have the heavy hand of government sort of putting a finger on the scale and making that decision.
I think we have time for just one more question.
Yes.
Julius Swoboda, International Trade Administration. You had meant, one of the things that was talked about with ExIm Bank was very low default rate, and also that credit is extended to projects where it might not be available in the private sector. But with such a low default rate, and these projects seem very secure. So can you talk about the types of projects that you would fund where they're one secure but might not be able to find credit on the credit?
Yep. Let me go back to the example of Transnet in South Africa, for example. Two things are operating there. One, we believe it's part of this is the perception of the banks in terms of what's secure and what their level of risk is. I think that coming out of this financial crisis, I met with 3 of our French banking partners last week. We may be, this is 2011 is a lot better than 2009 or 2008, but we are not out of this financial crisis. Witness, our economy is still growing slow. So there is a great reluctance still on the part of the banking community to make those loans. Secondly, more and more work is going to emerging economies, which also banks have some anxiety about working with, or have some certain other limits they will impose. Third, a number of them are trying to prepare themselves for Basel III and the new sort of banking reform. So those are factors going in the other way that often calls us to the table far more often. But to the example of South Africa, it's still difficult, even if they have a sovereign guarantee, a company or bank would prefer to have the US government try and make good on that sovereign guarantee than a particular bank will want to do. So that's frequently the factor. The locomotives are really good security. On the other hand, how do you repossess a locomotive that's 300 miles from Johannesburg if you decide they default? Very difficult. So we, the U.S. government, frankly, we have better enforcement of outstanding debts than perhaps an individual or a company or a bank. So frequently, although the risk may be greater, we have a better ability to enforce that. As the Congressman mentioned, our default rate has been running less than 2%. So we have I think we can do a better job. We also can be more patient. We have some outstanding loans in Venezuela. We can wait this out. So we have an ability to wait it out where a commercial bank would not have that ability. Thank you. Thank you for inviting me today.
Thank you, Chairman Harper, for joining us. We're going to turn it over now to my colleague Stephen Dizelle, just to bring a few facts in this. But I was struck by one of the things the chairman said about leveling the playing field and competing against the Chinese. And you hear that a lot from some sort of free market think tanks. Well, we'd just be better off if we just, why do we even need to do this? And the short answer is because everybody else is doing it. I mean, that's just the simplest answer. If we could somehow get sort of unilateral disarmament, I would actually argue even in that case we should still do it, but I won't go down that path. The reality is we're not going to get that. There is simply no way that we're going to get and convince Brazil to not be focused heavily on subsidizing their exports, or China, or India, or these other countries. So in that reality, we have to match that, if you will. Also, was a question here about non-tariff barriers. There's a report on our website, which you may be interested in, called The Good, the Bad, and the Ugly of Global Innovation Policy, which was a pretty thorough review of all the kind of non-tariff barriers or other mercantilist actions that countries take. Stephen, you want to come on up? My colleague Stephen Dizelle is the co-author of this report we've released today. I'm just going to go through a couple of quick slides, and then we'll turn it over to Gary.
Thank you. And I'm told that Representative McCarthy is on her way, so if she's able to make it by, I'll yield the floor to her. So as Rob said, I'm Steve Nizel, Senior Analyst at ITIF. Just wanted to share a brief set of overview viewpoints from our report on understanding the importance of export credit financing to U.S. competitiveness. You know, as has been talked about, the first reason export financing is critical to our economy is because it supports U.S. exports, and particularly those by SMEs. 85% of ExIm Bank's transaction activity is oriented to support the export activities of SMEs. And you know, one reason exports are so important to the U.S. economy, you look at this chart, what this shows you is the national export intensity of a set of nations that heavily use export credit financing: Germany, China, India, Italy, Brazil, the US. What you see is that China is a country that, as a share of its GDP, exports 4 times as much as the United States does. That's stunning when you consider that we're the largest economy in the world. In fact, the US is now only the world's 3rd largest exporter behind China and Germany. And you know what this kind of makes me think of is a remark that President Truman made in 1953. Truman said that American industry so dominates the world that the American worker no longer need fear the competition of foreign employees. Well, that kind of arrogant attitude that we have the world's largest economy, we'll be fine here on our own little island, we don't have to worry about the rest of the world. It's really belied by reality. We need to step up and become a much more serious exporting-focused country. And one reason why that's critically important is, as we talked about, the jobs that come from exports. So as Rob mentioned, economic studies show that if for any given industry, a 10% increase in sales due to exports has a 7% impact on employment, and only a 3.5% impact on employment if it's for local serving markets. So essentially, exports support double the number of jobs as production activity oriented towards the domestic economy. Exporting jobs are 10% more capital and 10% more skill intensive, and in general, export supporting jobs pay about 18% more than jobs that don't. So exporting jobs are good for the US economy. And of course, if we export more, that will help us balance the US trade deficit. I just want to run a few numbers by you so we're all on the same page about this, because the numbers are truly astounding. In the last decade, the US tallied a $5.5 trillion trade deficit with the rest of the world. $4.5 trillion deficit in manufactured products alone. We have a serious deficit to make up, and some people say we can get there with services alone. We need services to help close the gap, certainly, but we cannot get there if we're not manufacturing and exporting, because manufactured exports account for 57% of US exports. So, we must be better at exporting. So, why then should we have export financing? And I know that the chairman has talked about this a little bit, but I'll just give 3 quick reasons. First, because as we talked about, there are externalities from exporting. Because benefits from robust exporting accrue not just to the exporter, but to the overall economy, as we've seen, right? It helps close the trade deficit. It helps create better paying jobs, which have greater multiplier effects throughout the rest of the economy. So there are strong externalities from supporting exports in the United States. As we talked about, there is in fact real risk around exports, and so the ExIm Bank plays an important role to step in and close some of this political or technical risk to help our exporters when private markets will not respond to some of the challenges that are faced because of political or technical risk in dealing with foreign buyers who aren't subject to the same financial conditions and terms as might be the case for everyone in the United States. Furthermore, to Rob's point earlier, private markets aren't always acting optimally. You look at the venture capital market in the United States, which has 80% of VC activity going to just 3 states, and increasingly moving from lower stage deals to later stage deals. There's not kind of optimal market behavior from VC actors in the US economy. So there are market failures involved, and in exporting it does make sense for the government to step in and close some of those market failure gaps. And finally, as has been talked about, the third reason we need export financing is to level the playing field against foreign competition. And as Rob said, our foreign competitors have shown every intention of continuing to use export financing, and it's just a fantasy for us to say, let's unilaterally disarm and let go of export financing without any kind of agreement that our major trade competitors will stop doing that. Now, overall, what we find when we looked at the volume of export credit financing between the US and its competitors is that when we look, for example, in 2010 at the amount of new, medium, and long-term official export credit volumes as a share of GDP, you find that China actually does 10% more export credit financing as a share of GDP than the United States does.
10 times.
So does
10 times more.
Yeah, 10 times more as a share of GDP than the US does. Brazil does so as well. Even Germany, France, and India do 7 times more export credit financing as a share of GDP than the US does. Looking at the raw numbers in 2010, we see that China did $45 billion in export credit financing to about $13 billion in new credits, medium and long-term credits being offered. So that's a yawning gap. It was actually worse in 2008. In 2008, China did $60 billion in export credit financing. Looking at that year, 2008 alone, China issued 17 times more new, medium, and long-term export credit volumes as the United States did as a share of GDP. So when you bubble these numbers up over a couple of years, the results are actually quite astounding. So let's look at the numbers from 2006 to 2010. And what you see over these 5 years is that China did a total of $200 billion of export credit financing over that period to the United States, $57.8 billion. So that's 4 times more in absolute dollars. And then again, when you factor in that China's economy is about 40% the size of ours, it comes to 10 times more as a share of GDP. So clearly, export credit financing is a key component of China's technology and economic development strategy. And I think one critical point to make about China's strategy behind using export credit financing is that it is especially and specifically targeted at key US markets and companies. Let me read you 2 quick quotes from China ExIm Bank's 2009 annual report. It proudly proclaims that with regard to China First Heavy Industries, it has supported it, and China First Heavy Industries has seen, quote, enhanced market competitiveness and facilitated its exports of complete sets of large equipment to regions worldwide, including to America, taking away market share from Peoria, Illinois-based Caterpillar. Later on in the report, China talks about its support for the Aviation Industry Corporation of China, which in 2009 got $15 billion of assistance to help grow China's aviation industry. And the report says that, quote, we have helped China aviation achieve leaps and bounds development and see further integration into the international aviation industry. So, export credit financing is a key part of China's policy, and this is having real effects, right? In 2011, China will surpass the United States as the world's largest manufacturer. China's already surpassed us as the leading high technology export in the world. It's having an impact in the marketplace. So what are some attributes then of China's use of export credit financing? Well, first, just to make the point here, China has supported a single company, Huawei, with half as much EXIM financing, $30 billion, as all US firms combined received from 2006 to 2010. The $30 billion credit line that the China Development Bank gave Huawei has really had profound impacts in the marketplace. In just 1 year, Huawei went from $2.5 million in sales in India to over $1 billion. If you look at the impact in Brazil, the CEO of Telenorte, which is Brazil's largest landline company, reports that, quote, the presence of below-market credit was a major reason for us choosing Huawei over American and European competitors. The deal that China was able to get with Telenorte essentially was 2 percentage points below the London interbank rate and offered a 2-year grace period on repayments. China's export credit financing does not follow international norms, particularly with regard to tied aid practices. What this refers to is development assistance going to a nation that is conditioned or predicated upon this country purchasing goods or services from a country. So China will go to one of these countries and say, we won't give you development assistance unless you're buying our products and services. And that's like a not fair form of competition, which would in fact not be allowed if China entered the OECD agreement on export credit financing. So then, what are the policy recommendations we would propose to Congress? First, we've had great success today already, but Congress should make a timely reauthorization of the ExIm Bank the paramount priority. We can have legitimate discussions over whether if the local content requirement was 2 points greater plus or minus, that might be more optimal. The reality is that 88.4% of the content in the transactions the bank has processed over the past 5 years have been domestically produced, so we think 85% is set at a good point. But what this data really shows is that Congress should substantially increase the authorization limit for the ExIm Bank so that we might provide more export credit assistance to our companies so they can meet the increasingly formidable challenges they're encountering in global marketplaces. Thanks very much.
Gary, some of you came in late. Gary Huffbauer is the Reginald Jones Fellow at the Peterson Institute for International Economics and has a recent report out on ExIm Bank, which is out on the table as well.
Thanks, Rob, and if the Congress comes in, you just interrupt and go straight to her. As Rob mentioned, our report is out there, and it was done before this reauthorization, so it meant to influence the reauthorization, but we weren't entirely successful. So what I'm going to emphasize, agreeing very much with the presentation that Steve made on the main points and what Fred Hochberg said, I'm going to emphasize probably more the differences, just to bring some interest. And let me just go over 5 points out of the policy brief. There's obviously more than 5 in it. First point would be that, and this is very much in line with what Steve just said, ExIm financing should be dramatically increased if we're serious about this national export initiative goal. One wonders how serious we are. But we should strive for 5% of exports to be financed by ExIm, which would put us in a competitive range. We're now about 2% when you take medium and long term. So translating that into real numbers, we should have a target of $75 billion a year. Of course, this rolls over, but in our view, the reauthorization target shouldn't be what they're talking about now, which I think is something like $160 billion. It should be more like $200 billion. It should be a larger number. Second point, on domestic content, and here I guess there might be a little disagreement up here on the podium. We think that this 85% requirement, which is self-imposed by ExIm on itself, it's an administrative requirement, it's not legislative, should be dramatically cut. This is quite anachronistic. No other country has this, and it's completely out of line with the way supply chains move. It does lose business. So our view, and we argued in the policy brief, it should be cut at least at 50%, which is more in line with what competing export credit agencies have. Third, service exports. If you take the long view, by which I mean a 10-year view, service exports are going to be, or should be, the really growing portion of the U.S. export agenda. And by that I mean business services of all kinds, the whole range of business services that might pop into one's mind: education, health, obviously finance, consulting, et cetera, et cetera. We are very strong in this dimension. Our exports are way under the potential. There are a lot of barriers abroad, but let's talk about the barrier here at home for this afternoon. ExIm really doesn't pay any attention to services. Lip service, not real attention. It needs to count services as part of the content for any content requirement, and it needs to do a much better job of financing standalone services, that is, services which are not linked to a locomotive sale, for example. Fourth, we have a cargo preference requirement which really does date back to the 1930s. And this is completely outmoded. No other country does this kind of thing. And you have more than a 20 million shipment, you've got to, go through the hoops to get a waiver, and that ought to be knocked out, or at least the way of getting a waiver should be dramatically reformulated, so it isn't a matter of going and begging to the MARAD. The MARAD would have to affirmatively show why it doesn't grant a waiver within a short period of time, 20 days, something like that. So that was our fourth. And finally, let me just end up with the tide aid point, which is rightly played importantly in the ITIF report, and I think they have a lot of good numbers. I was just scanning it. I mean, this is a big thing. It's focused on China, but it's not only China. And I go a step beyond where Fred Hochberg advocated. I think the United States should be out there encouraging other OECD countries, the ones that are members of the arrangement, to match China unless, that is Chinese exports, unless China affirmatively discloses. In other words, not hiding in the secret basket, what we're doing. Unless China affirmatively discloses, I would say take the wraps off and match China. U.S. doesn't have enough money to do that alone, but we need to get the UK, Japan, France, et cetera, in on the party and have a very strong policy. Now, the end result of this policy should be to get China into the OECD, not as a full member of the OECD, but in the arrangement, and there is provision for that, to sign up and become more transparent. China first, obviously Brazil and India right after that. But I think just playing polite and nice to China is not going to do the trick, and it's going to do a great disservice to our exporters in the decade ahead. Let me stop there. Thanks very much.
So Gary, I thought you were going to be controversial. You weren't, at least for us. Just quickly go on all your 5 points and then we'll open it up. We absolutely agree that the number should be a lot bigger, so agree with you on number one. On number two, about the 85%, really what we're saying there is, the debate over the 85% is if you raise it to 100, would people, pull their supply chains back to get this export financing? And clearly the answer is no, although that's the theory for going up. The theory for going down is that you exclude a lot of companies that have global supply chains. And so our only point there was we shouldn't let the reauthorization get bogged down on that, but from a principle point of view, we would agree that going down from the 85% number is the right way to go because it reflects the current realities. And you would end up getting more exports because you're supporting companies that have the ability to export, and whether it's 75% or 60 or whatever the number is, we don't have a position on that. Cargo requirements, have no position on that, haven't studied it. Your last point about OECD and matching, we could not agree more, Gary. We are kin and cousins here. We totally agree. I think the current approach to China, which is to beg them and plead with them to play nice, is destined to failure. We've seen it as having no effect up until now. You just have to get tough on them, and I think the best way to get tough on them is for a coalition of the willing. In other words, the OECD countries, in particular our key trading partners, as Gary said, the ones who generally play by the rules, they generally let their currencies be set by the markets, they generally don't over-subsidize, to have them work together and really put real serious pressure on China, and ultimately on Brazil and some other countries like that. So we're, I think, not in really disagreement in anything really you said. We may be joined by Representative McCarthy, but why don't we just open it up for comments or questions, if you can identify yourself first. Yeah.
Hi, Chris Law, Office of Data Research. This is probably for Steve, but maybe for all of you. I thought the earlier question was really important about the level of risk we're willing to tolerate. It seems to me that when jobs are created by entrepreneurs are by nature, in the risk mix there. Advertising a less than 2% default rate, if we're trying to be equal across the world, is only important if everyone else is at 2%. What do we know about the tolerance for risk that these other countries are entertaining when they finance this stuff? Are they willing to take chances on companies that we're not willing to take chances on?
Either of you want to respond to that?
Well, back decades ago when I was in the Treasury and handling this file, we went through some financial crises, nothing like what we've had lately. And some of the agencies, COFAS and the Hermes and Switzerland and so forth, they basically lost all their capital in a couple of those crises. So but of course they refunded, financed by the government, the money came back and so on. So there have been big drawdowns on occasions in the past. The 2% figure is a lifetime for the ExIm, which has been, I would say, more conservative than let's say, the OECD population on average. What China's experience will be, that's hard to say. Whether they ever disclose it, that's harder to say. But I think the point that Fred Hochberg made, that the perception of risk exceeds the actuality of risk in many cases. That's one point. And the second point is the ability for ExIm to take a much longer view than a commercial bank for obvious reasons. And that would be true even without the recent financial crisis.
I guess part of your point is the risk issue comes up if we raise, they don't have to be worried about that now because there's not that much money at stake. They don't have that much money to lend out or do guarantees for, but as they get up farther, then they may have to confront that issue a little more. My own sense is that China doesn't think too much about the risk because they're largely on the upside, not the downside. They're willing to throw an enormous amount of money. We've seen that with many investments the Chinese have made that are really just, one would argue that they're just pure waste. But if they can get 50 cents on the dollar for a lot of these investments, they're happy to do that because they're taking quite a long-term view of how to grow their competitive advantage in the world economy. And we take a much more shorter-term view. Thank you, Frank said they take somewhat longer view.
And when they're working with $2.85 trillion in foreign currency reserves, most of them are, so they can afford to take a few more chances, can't they?
Other comments, questions?
Well, there's also the support that.
Could you identify
I'm
yourself?
sorry, Marlene Davis, I'm with Motorola Solutions. And back to the point about the Chinese and their export financing. The other problem we face is that many of the Chinese companies are state-owned enterprises. So even without the export credit agencies, they are financed by the full faith and credit of their government. So are these numbers included in your analysis, or are we looking only at export finance agencies?
I mean, I think these are the numbers that are specifically demarcated as being for export credit financing support. Now, to your point, are there other instruments through which these Chinese state-owned enterprises are benefiting, including illegal export subsidies? Absolutely. So there's a range of support that these SOEs get, also including access to markets where they don't have to face international competition. Texas just put in place one of the largest wind turbine farms in the entire world. We bought Chinese wind turbines, of course, but not a single U.S. wind turbine has been sold in China since 2005. Because they argue that since they're not members of the government procurement agreement, the GPA rider to the WTO, then therefore the rest of these government agencies and they're not to.
So as U.S. companies look at export finance agencies or export credit agencies for support because the deck is lined against them, we are faced with content requirement, we are faced with a whole slew of things that put us in the proper holier than thou category. We have to do this because this is the right thing to do, and as we do that, we continually lose market share. Huawei is a great example of the competition between Motorola Networks and the Chinese. They basically took the whole market because they were able to give cheaper products, cheaper financing, actually free financing to projects, sometimes free equipment. So the decks are stacked against U.S. company competing globally, and if we insist on just including manufacturing assembly line jobs, when our economy and our kids, new graduates are concentrating on the service economy, how much are we hurting U.S. companies' competitiveness overseas?
Well, I think the general point you're making, and I think you're right. I mean, China has a specific industrial policy designed to pick off and win in the highest value-added sectors of economic competition, and those are the ones that the U.S. has generally played in the past. So they're targeting routers, they're targeting jet aircraft, they're targeting biotechnology now, right? Any number of industries. So, I mean, I think the key point for policymakers to take away, I think, we had an event on March 10th on the state of U.S. competitiveness, and the point you have to understand is we tend to envision a world in which Chrysler and Ford go out and compete with Toyota, Nissan, and Mercedes-Benz. There are companies compete as independent actors in global markets. What's happening now is that U.S. companies are competing in global marketplaces against the technology ecosystems of their countries. So, Ford is competing against Nissan and the Japanese government. Cisco and Motorola aren't just competing against other networking firms in the world. They're competing against Huawei and the Chinese government. So when we make policy making, we have to look for ways to find more effective public-private partnerships with our firms.
This is, the French do it, the Italians do it, the Chinese do it, the Indians do it. My point is, when these governments are fully supporting their companies, with our, whether it's export financing credit, requiring U.S. companies to have 85% content.
Sure, and I think your point is that, I think I know your point.
They're supporting their companies, and we are not fully supporting
Sure.
our companies,
Right.
is what I'm saying.
Yeah. And it's a broad array of policies. I mean, we have focused on it in the areas as well, a wide range of policies that are determining U.S. competitive advantage in these markets. And export financing is just one of them. I mean, there's 15 we've got to get right, and we get 14 of them wrong. I think we get 15 of them wrong. So this is not a silver bullet, but it's certainly a bullet in the chamber that we have to have if we're going to win. Any other?
Let me just add one comment. I mean, yes, the things that ExIm is doing to itself, or the Congress is doing to it, that's our problem. We could actually cure that at home. But that, as I just said, and Steve, I mean, that's a small part of the total Chinese picture, given the vast influence of state-owned enterprises and the size of the finance and so forth. To some extent, we can bring cases in the WTO. They take quite a bit of time to grind through. 2-3 years is a good best case estimate. So that's pretty slow, and I don't think we now have an appropriate array of policies that cope with China when you combine the SOEs, the intellectual property issues that we know about, plus a lot of subterfuge, espionage policies, which are not so much in the public domain, but are pretty troublesome, and then the export credits. This is a real challenge, and I don't think we're up to it just yet.
Well, great. Unfortunately, Congresswoman McCarthy is not able to join us, but I think she probably would have said there are similar things to what we've heard today. So please join me in thanking Gary and Stephen, and thank you all.